everyone knows We were just having a couple drinks.
Welcome to the stream. How's the audio coming through? So as you can see, I took a bunch of short trades. Just started piling in after this move down. There's going to be a bounce back, of course. So I added another one. Then I just when it cleared this green bar, piling in again, and then getting out at the moving average, and then get in again and start covering. Hmm. Interesting. What is in this? Anybody trading this market?
animal spirit from us.
Exactly. And then you start to say, okay, now have to start taking until then, right? Are there other things that are going to cause volatility, whether it's the Fed, whether it's tariffs, whether it's something from the administration? Sure. But what we really worry about is that resetting of expectations.
But for the meantime, we may be a little bit volatile and a little bit messy for a little bit, but then we sort of realize all that's coming from D.C., tax cuts, deregulation, stronger economic growth, decent enough earnings, and we're good.
Yeah, that we're actually in a pretty good spot. We're going to price it as we're in a pretty good spot. This is the first, I don't think people really understand or appreciate what the regulatory environment's going to look like in 6 months.
Well, tell that to the banks. I mean, those stocks have been ripping.
Right.
For a reason.
They have been ripping. They pulled back a little bit. But I do think the banks, which is one of our top ideas for next year, they're going to have EPS growth. We're going to see upward EPS revisions, and you're going to have upward multiple revisions. That's something that we haven't seen in years.
Private equity names rallying for the last few months on the expectation of more deals.
Right, more deals, right? So merger arb has been a very difficult spot to be. Merger arb probably bounces back next year. We'll see more deals. With more deals, you have more IPOs. With more IPOs, you have more trading. The capital market business improves, and it builds upon itself.
That's why the exchange stocks have been doing pretty well, too.
Exactly.
In anticipation of all of that. Let's broaden the conversation now and bring in Bryn Talkington of Requisite Capital Management, Malcolm Etheridge of Capital Area Planning Group. Great to have both of you contributors with us. Bryn, you first. You've heard the view. Mr. Harvey, you agree?
I agree with a lot of what you have to say. I think this deregulation, you have to think about this, could really be a multiplier effect to so many parts of the economy, because, we do have this fourth branch of government, these federal agencies that take from Congress the laws that they pass and then interpret them. And I think there's so many industries that have been laden with bureaucracy. I think that can really help animal spirits that are already in existence. But that deregulation to me is this multiplier in the economy. But I think if we get some wins there, that's going to be a really strong, I'll say, tailwind to potentially U.S. GDP. And so it feels like, going into at least the first 6 or 7 months of the year, if the administration can get some wins and get some wind behind it back, I think it's going to benefit equal weight. I think it's going to benefit energy, materials, which really have suffered this year. And so I'm thinking you can get a rally that where the market cap stocks go higher, but these other stocks start to participate in a more meaningful way, which they really haven't done this year.
So, Malcolm, even like tariffs and trade wars, I understand that those are potential negatives, but, Bryn's suggestion here is that there's going to be enough good to offset whatever bad, if you characterize that as bad. I'm thinking of in terms of how the market would take those. Is that true? Is that what you believe?
Yeah, one place I hear overlap, at least between Bryn and Chris, that I also echo is probably deregulation when it comes to financials, right? So when we talk about all the other industries that have been laden with bureaucracy, I would say financials, banking specifically, has probably been hit the hardest. And I think that even if a lot of the deregulation that we're excited about the potential of, and maybe even some of the tariffs that we see as being unnecessarily harsh back to the U.S. do actually go into effect and have some of the negative effects that we're afraid of. I think something as simple as bringing down the corporate tax rate, which has obviously been a proposal on the table for a while, that's going to immediately impact banks more than a lot of the other sectors because they don't have any of the places to hide out, like healthcare, for example, or tech. Obviously, there's no R&D expenses to tuck away. And so something as simple as just a meaningful corporate tax cut, again, is going to be another catalyst and a wind at the backs of the bigger financials, for sure.
Chris, there was a suggestion earlier this morning on the morning show that I was doing with Sarah Eisen that the markets and investors are too fixated on tariffs and anything negative like that. You could still get 15 to 20% next year return in the S&P, if not even more, if a lot of the other things, more important things, like deregulation, like tax cuts, like better economic growth, like stronger earnings actually fall into place. And the tariff thing, we're not exactly sure. We, I think, can make an educated assumption that there will be some, but maybe not to the degree and the scope and breadth that has been talked about.
I think that's all fair, right? I think part of what we're doing is we're speculating on speculation, right? The thing that I kind of come home to is that it does appear that with our allies, you're using tariffs, so the administration, the incoming administration is using it as a cudgel, they're using it as something to bring people to the table. I do think that tariffs between US and China will happen, right? But at the end of the day, if you look at the US economy is not driven, it's not an export-driven economy. It's a service-driven economy. The consumer's still okay. And you're right, if we're going to have a lighter regulation environment, if we are going to start talking about tariffs, if we do shrink the government, these are all really good things that will supersede or overpower any sort of tariff issue. And again, we don't know when tariffs will come in and to the degree that they will come in. But it doesn't look like they're going to be very aggressive.
Sounds, Bryn, like you agree.
Yeah, I mean, absolutely. I think that when you listen to, Trump and all of his other officials talk about tariffs, there's definitely other side to that. With Mexico, it's getting the drugs out, it's immigration. And so I think that this is more of a stick. And I think, once again, the China tariffs that Trump, instilled back in his first presidency, Biden kept that through. And so I think I agree with Chris that there's speculation on the speculation, but ultimately I think this deregulation and having this growing economy where more people are included is really going to be the narrative. And I think that puts a really positive tailwind to the economy, writ large next year.
Malcolm, you look at what's worked lately, obviously, and it's been the NASDAQ. I mean, we're having a 30% year for the NASDAQ, and over the last month, it's the only of the majors that is higher, up near 4%. Everything else is red over the last month. It just shows you where the money has been going. The problem, some say, is that those stocks aren't cheap and that their earnings growth just can't sustain at current levels, even with the multiple having expanded by the magnitude that it has. So how do I justify that trade continuing to work to the degree that it has?
Well, I will see your concern there, and I'll raise you one. I agree with everything you just said. That is a concern going into 2025. But I also think that as we look at the slate of IPOs that we all are agreeing are likely to come in 2025 and probably pushing into 2026, in order for investors both on the retail side and as institutional investors to participate in that, they've got to raise cash from somewhere. And it's more likely to be the larger, more dominant Mag 7 names that are widely owned by just about everybody at this point. Those names are going to have to be sold off in order for those investors to raise cash to participate in those IPOs in a meaningful way. And so even if earnings growth continues at the rate that it has, and we do continue to see positive revenues for a lot of these larger tech names, I wouldn't be surprised to see the share prices still suffer as investors are trying to come up with the cash to get into those big blockbuster IPOs.
As I was asking Malcolm that question, my peripheral vision caught Harvey like, I'm not sure I agree with Wagner on that. Do you have any of those concerns about elevated multiples, especially at the highest end of the cap space in the market?
There are elevated multiples, no doubt about it. But what we're observing, what we're seeing is momentum. We've talked about momentum all year long, right? And what you're seeing is the effects of momentum. People have made a lot of money buying strength, avoiding weakness, or buying strength, selling weakness. And that continues to work. And so what you should expect is people to continue to do that. They're going to keep pushing their chips in. They're going to keep playing momentum until it stops working. And that's exactly what you're seeing, or I think that's exactly what you're seeing with the NASDAQ and with some of these higher prices. Would I recommend that? I think momentum will continue to work, but we want to start being a little bit more conservative on our valuations.
I mean, one of the predictions from Torsten Slok over at Apollo, Bryn, and I read a list from earlier, is that NVIDIA disappoints. 90% probability, he puts, that NVIDIA will disappoint. And if in fact that happens, I wonder what you think the fallout would be more broadly.
Well, I thought it was a great report, but I think when he says they're going to disappoint expectations, it's not like they're going to miss numbers.
Well, it's always all about expectations.
Yeah, but I think that's a little bit nebulous at this point. I think that NVIDIA, I own it, but I also sell calls against it. And selling calls against it the last few months has been great because the stock really hasn't done anything. And I think that right now the stock is digesting. I think NVIDIA is going to continue to put up record earnings next year. Now, where are expectations in Q2 and Q3? I don't know. Do those come down? They could. But I think NVIDIA's had two banner back-to-back years. It's digesting and consolidating. But I think as these hyperscalers are going to spend $50 billion this year in CapEx. I think that's going to continue to be strong. I still think NVIDIA, and then the market's now saying Broadcom, are really the two semi names you still want to own going into 2025.
Let's see, Malcolm, you don't think that these hyperscaler names are going to be as dominant next year as they were this. I think we've laid out a number of scenarios which potentially would question that.
Well, to Bryn's point, I think the company and the stock are two completely separate things, right? NVIDIA is sold out well into the future by 10 years or what have you. Any chip that they can make, there is a willing buyer on the other side of it. And just about at any price NVIDIA decides they want you to pay for it. But the difference is the expectations by Wall Street now, the expectations by investors are that companies are going to just continue to beat and raise and beat and raise and beat and raise. And I think that we've already seen a growing skepticism, dare I say, from NVIDIA shareholders, which is part of the reason that the stock has been trading sideways for a little bit now, to Bryn's point. So I just think that in tech, specifically mega cap tech, in next year going forward, I think that investors' expectations are just weighing so heavily on these names that any earnings growth that we're seeing them be able to show at these quarterly reports are not going to be meaningful enough, because investors are going to be looking over on the other side of the fence at other companies that are still delivering double-digit growth quarter by quarter.
All right, last question. This is Chris Harvey, and maybe I'll get a Bryn reaction, then you'll understand why in a minute. Bitcoin. 92,600. One of your predictions is that Coinbase is going to be added to the S&P 500 in the first quarter of 2025.
Yeah.
Why'd you pick that out?
So what we're seeing is the institutionalization of cryptocurrencies, the acceptance of it, right? And as a result, we think you're going to start to see that reflected in the broader market being the S&P 500. Wherever we look, you are seeing cryptocurrencies being more accepted, more institutionalized, whether it's in ETFs, whether it's in people's personal portfolios. We always say that if you're less than 40 years old, you speculate on cryptocurrency. If you're more than 40, it's gold, right? That number looks like it's starting to move up as well. But to answer your question, it's really just because we're seeing the acceptance of it and the broadening of it. And at some point, we'll see it in the S&P 500, and we think in the first half of next year.
Bryn, is Bitcoin and crypto just getting started here?
Well, it's selling off a little bit right now, but I think if you look out,
but in the bigger
5
picture,
and 10 years, yeah, I think if you look out 5 and 10 years, I think Bitcoin could be much higher. I do think, though, that people forget how volatile this asset. I mean, this Bitcoin could easily go to 65,000 before it goes to 150. And I think that I've talked about this. The leverage underneath the cryptocurrency gets quite large, and you need that to consistently wash out. And I think that will remain the narrative, that it's a highly volatile asset class. People get over their skis, but longer term, it looks like it's going to continue to go higher.
We will leave it there. All right, everybody. Thank you. Bryn and Malcolm, we'll see you soon. Chris, thanks for coming by Post 9.
Thank you.
It's Chris Harvey. Let's send it to Pippa Stevens now for the biggest names moving into the close. Hi, Pippa.
Hey, Scott. Shares of MicroStrategy falling 7% today on the first day of its inclusion in the NASDAQ 100. The Bitcoin proxy announced today that it bought more than 5,000 Bitcoin at $106,000 each, funded through a stock sale. Bitcoin traded around $93,000 this afternoon. Meantime, Nordstrom is in the red after it agreed to a $6.25 billion buyout from the founding Nordstrom family and a Mexican retailer. Common shareholders will receive $24.25 in cash for each share, and the deal is expected to close in the first half of 2025. And Walmart is the biggest laggard on the Dow today after the Consumer Financial Protection Bureau sued the retail giant over its payment of delivery drivers, alleging that Walmart and scheduling platform Branch Messenger forced delivery drivers into costly deposit accounts to receive payment. Walmart called the lawsuit, quote, rushed and riddled with factual errors. In a statement to CNBC, those shares down 2%. Scott?
All right, Pippa, thank you. Pippa Stevens. We are just getting started. Up next, the high net worth playbook from one of the top firms in this year's CNBC Financial Advisor rankings. Chief strategist Mary Lago of Ferguson Wellman shares her strategy for what sectors you need to be in this market and where she finds the best opportunity in the alternative space. We're live at the New York Stock Exchange. You're watching Closing Bell on CNBC.
50% off.
Welcome back. Stocks mixed to start this short and trading week. Our next guest manages money for high net worth clients and is still constructive heading into the new year. Let's bring in Mary Lago. She's Chief Wealth Strategist at Ferguson Wellman. Welcome back. Nice to see you.
Thank you so much for having me.
So you're pretty constructive on the markets at this particular time?
We are. We recognize that valuations are a little stretched, but we remain very constructive on domestic large caps. Looking at 25 times forward earnings, we know they can look a little expensive, but if we look over the last couple of years, the earnings and even more so the stock prices have certainly rewarded investors that have stayed the course.
Stay the course with mega caps and things like that? Is that what you're alluding to?
I'm referring to large cap equities in general, but certainly mega caps have rewarded even more so. And we expect, if we look forward to earnings for 2025, mega cap earnings are expected to grow over 20% next year, broader market at 15%. So we've got some strong earnings projections ahead, and we're still leaning into that.
Where are you looking to get more positive that maybe others are missing?
I'm sorry, why do you think we're more positive than others?
No, where within the market are you looking to get more positive where some others may be missing, things that just didn't perform that well? There's a healthy skepticism around certain sectors. What do you like that some others may not?
Yeah, well, I would certainly say there's some things we're watching. We still remain fairly positive in technology. We think technology is really at the forefront of some of these changes right now, reshaping industries. So while there's a lot of fear in that space, and we've heard some of the commentary earlier today, we remain very positive in the tech space. Certainly industrials, they're benefiting from some of that carryover effect with data centers and other points. So we remain positive there. Real estate certainly has been tough, and we're a little bit underweight in real estate, but looking to be more constructive as we're seeing some bottom clearing prices in that space.
No appetite to invest in international stocks, just stay U.S., generally speaking?
We have remained underweight international, and there's certainly pressure there, right? They look very inexpensive from a PE ratio perspective, but cheap isn't a catalyst. And what we're looking for is some indication that earnings are going to improve internationally before we want to step up that. And we're even more underweight emerging markets.
Why overweight consumer staples, which I see in the notes is one of your calls here?
Yeah, it's really a little bit of a hedge, if you will. We recognize we're overweight some of the more cyclical, higher beta sectors, such as the tech and industrials. And so in a way, it's not our base case, but it's a little bit of a hedge against any weakness that we could see.
You have a bit of a contrarian take on a couple of hot areas of the market. Number one is you say you've trimmed your alternatives exposure. I haven't had anybody come on and say I've trimmed my alternatives exposure. I'm leaning into my alternatives exposure. I don't have enough. Why are you trimming here?
Well, part of the reason we're trimming is to make way for fixed income. We believe that bonds have earned their way back into portfolios. You know, we've seen the yields on the ag at 5%. We really added to alternatives over the last 5 years as a placeholder for bonds in the sense that interest rates were low. We knew they were going to be rising. We didn't want to get hit with that headwind on our fixed income side. So we used alternatives in the form of some real estate, some private credit, some real assets to try to hedge some of that risk in fixed income. And now as fixed income yields are looking better, we needed a source of funds to add back into normalize or stabilize what would be our more normal allocation towards bonds.
I haven't had anybody in the same light, speaking of alternatives, come on and suggest that private credit isn't a good place to be. And I haven't had anybody suggest that private credit is nearing an end in any way. In fact, they suggest continually that we're only in the early innings. But that's an area that you're likely to trim as well. You think there are too many dollars there?
Yeah, that's exactly our concern. We're seeing a tremendous amount of inflow into that space. And we recognize from the broader perspective, right? Banks want to strengthen their balance sheet. They're being more conservative. There's the need for credit. Private credit is filling that gap. But we've seen so many dollars rushing into that space that we think that could force some compromises in terms of quality. And so it's not that we think that there's an imminent problem in that space, but there's illiquidity constraints, and we'd rather be out a little early than a little late.
What kind of returns, lastly, do you think we're going to get next year out of the stock market broadly?
Yeah, probably looking at, again, if we look at broad earnings at 15 times, if we stay the same, we'd say we'd have 15% earnings, but that's not what we expect. We expect that we've already been paid for a lot of the profitability that, or the earnings that companies are going to show next year. And so our expectations are more for 5 to 10% growth on the S&P.
Wow. So reasonably muted returns. Not that 10% is anything to sneeze at. It just certainly feels like it would be a disappointment relative to the last couple of years we've had.
It does, coming off of that, doesn't it?
Yeah, I mean, 5% sounds a little like it would be a disappointment. It's certainly relative to expectations of, tax cuts and deregulation and stronger economic growth, right?
And we also recognize that there's policy risk going into next year as well. So we believe that companies will continue to perform, that they're going to meet those earnings expectations, but that there's likely going to be some softening around price to earnings ratios. And we don't expect that earnings expansion next year, which has fed a lot of the last couple of years of returns in the S&P.
Mary, we'll talk to you soon. Good to welcome you to our program. Mary Lago joining us. Coming up, betting on the bull case, Citi's head of equity trading strategy, Stuart Kaiser's back. He'll tell us why he sees stocks bouncing back from last week's volatility. It's next.
tradingview.com.
Welcome back. Is there still time for an end-of-year rally in stocks? Let's ask Citi's head of equity trading strategy, Stuart Kaiser. He is back at Post 9. Welcome back. You think, I mean, are we still going to have a Santa Claus rally, which is technically, as Pisani was telling me earlier, supposed to start tomorrow?
Yeah, I mean, I think we're kind of set up for that at this point. You had a little bit of a positioning destruction last week, which probably helped kind of rebase things a bit. I think if you take the Fed at face value, which is kind of a flattening out unemployment rate, inflation still on a downtrend, getting a couple insurance cuts in there, that's all kind of net positive for equity. So I think your path of least resistance is to the upside of the year end.
It still is. Like, we're not upset too much by what Powell said last week, or the fact that we did have a hawkish cut and felt like decidedly so.
Yeah, not too upset. I think really what happened there is the Fed kind of confirmed what was a bullish growth outlook. They sprinkled in a little additional inflation risk. And I think that additional inflation risk is what you traded last week. That kind of worked against what was very long positioning. We think that positioning dynamic has kind of worked itself out. So now we're back to the situation where if we get a nice payrolls report to start next year, I think equities will respond really well.
Okay, so then if we do have some kind of upset, let's just say between now and the end of the year and then into the early part of 25, you'd be a buyer. That's what this sounds like.
Yeah, we're a buyer with the one contingency that employment report on the 10th of January is an extremely important event. But yeah, I think if you got a couple percent pullback here, I think you are a buyer of that dip, and then you're kind of read and react to the data as it comes in.
When you say, that data point is critical, I mean, how are you gaming that out? What makes it so critically important?
I think what makes it important is the Fed is telling you we think the unemployment rate is going to stabilize around these levels, and that's why we're able to kind of reduce the number of cuts we're going to do, next year. If you get an upside surprise in that employment data, that's equity negative, full stop, because your growth data is weakening. But that probably then puts the Fed in play to do more cuts later in the year. So we do think it kind of plays into a key part of their economic projection.
I mean, that would introduce just more risk of being forced to do more cuts, potentially at a time where we're thinking we may get reinflation from some of the policies in D.C. and the new administration.
No, I agree with you. I think there's a case to be made that in the first half of next year, the Fed could be in a really uncomfortable spot, right? Where you have unemployment rate rising, the government efficiency kind of trying to stop federal hiring, which has been a big part of the jobs growth, and then you get tariffs, which kind of push inflation a little bit higher. So there is a scenario there where the Fed kind of gets caught between a rock and a hard place, without a doubt.
What does the market look like, do you think, next year? We're ending in a place that's made people a little bit uncomfortable, right? We're back top heavy. How does next year look?
Look, I think risk reward is tough going into next year in the sense you have a very high EPS growth forecast. You have very extended valuation. So to your point, any bad news is going to kind of not be welcomed and actually punished pretty severely. That said, if the unemployment rate flattens out and you generate that earnings growth, then equity should kind of be up, a modest number. You wouldn't expect it to be 20% plus. I think, let's call it earnings growth is mid-teens. So you're probably playing for something in the 10 to 15% range. Best case. Worst case, you have something that looks like 2018, let's say, where you kind of had underlying decent data, but you had a couple really big pullbacks because of the risk environment you were living in.
But what does the makeup of that look like? I mean, if rates, let's say, remain elevated, you get fewer cuts, and maybe it's partly on the jobs report. The broadening story is built on strong economy and rates coming down. Mm-hmm. Anything that upsets that throws all that out of whack.
Yeah, no, I agree with you 100%. I mean, if you believe we're going back to the higher for longer narrative, that was the first half of 2024, right? And what did well then? Your large cap, your growth, your kind of safer stocks, right? What started to cause the rotation? To your point, during the summer, we actually got a broadening out of EPS growth. The 493 actually generated positive EPS, and we got a nice rally and broadening out. So next year, the earnings are set up for broadening. The question is, do we realize that? So that's going to be the ultimate test, I think, for next year is do we get the broadening out in EPS that we started in 3Q? Does that follow through into 2025?
Would that be the way that you would invest in the market? You would, maybe take a little bit off of the idea that mega caps are going to have this outperformance yet again and then play for the broadening that we're debating here?
Yeah, to me, your core position right now should still be in that higher for longer sort of situation because that's what the Fed is telling you is going to happen. And I think that needs to be your base case. So I still think you have some discretionary telecom services and tech as a core position. And then, do you want to sprinkle around some broadening? Yes. The trouble with that broadening trade, I think you alluded to it, is if you get weak economic data, that broadening trade just falls apart immediately. So you need to be kind of very careful about how you broaden out. Otherwise, you kind of, open yourselves up to a big risk. So I think your core position position is, call it large cap growth as a core position, and then you're kind of sprinkling on some risk, some risk in that broadening story. But I think you need to be very careful with that risk, in my opinion. Yeah.
Okay, we'll leave it there. Stuart, thank you.
Thank you.
Stuart Kaiser joining us here, as we do have all three of the major averages are now green. We are tracking the biggest movers into the close today, and Pippa Stevens is standing by once again with that. Tell us what you see.
Well, two automakers are driving towards a possible merger. We've got the names to watch coming up next.
Co.com. We're about 15 from the bell. Back to Pippa Stevens now for the stocks that she is watching. Hi, Pippa.
Hey, Scott. Honda and Nissan both higher after the pair jointly announced they'd enter merger talks. If combined, the company would be the world's third largest automaker by sales. Honda CEO said the companies needed greater scale to compete in the development of new technologies in electric vehicles and intelligent driving. Meantime, Xerox on pace for its best day since January after announcing its acquisition of printer maker Lexmark International for $1.5 billion. Xerox's revenue has fallen for 5 straight quarters, and the Lexmark deal will provide necessary scale to better compete. And Eli Lilly shares on the rise after the FDA approved its weight loss drug Zepbound to treat moderate to severe sleep apnea in adults with obesity. The approval could pave the way for Zepbound to be more broadly covered by insurance plans. Sleep apnea treatment companies ResMed and Inspire Medical Systems both falling on the news. Scott?
All right, Pippa, thank you. Pippa Stevens still ahead. Chips and dip, the semis underperforming the past few months. Is there more pain ahead, or could a rebound be in the cards? We are back on the bell right after this.
What's next?
Market Zone's next. down the closing bell market zone. CNBC senior markets commentator Mike Santoli is here to break down these crucial moments of this trading day. Plus, Seema Modi on the pivotal year ahead for chip makers and Apple hitting a record high again today. Steve Kovac will join us with that. Mike, I'll turn to you. And we have a pretty decent end of day move here, which was an otherwise sort of ho-hum day.
Yeah, market did build a little bit of strength throughout the day. Market breadth is still not impressive, but it's better than it was at the start of the session. Obviously, you have that bounce in semis, but aside from that, other year-to-date winners that are just getting kind of walked up into the end of the year. I think big picture, it's good to have kind of a calm, kind of low-key end of the year, if that's what we're in for. We had the fever break on that sell-off middle of last week. It's felt like we really did clean up positioning. The thing I'm still watching, though, is Treasury yields. There's not a lot of give there. The 10-year back at the upper end of its range, pushing 4.6 again. Now, this somewhat could be a matter of, look, selling your losers. Bonds were losers this year, but also illiquidity among banks and dealers at the end of the year. So maybe it's getting exaggerated. The yields are at levels where it should attract some buyers. They look overbought, but we have to see that happens soon.
Yeah, I mean, you've got a pickup in almost all of the sectors today. I mean, staples and materials are still in the red, but tech is leading. Comm services, no big surprises. Yep. We still debate whether, Mike, this broadening is going to work, at least in the early part of 25.
Yes, and I think it really is an active debate. I think that there's no way to settle it that easily. Yields have a lot to say about that. The cyclical parts of this market have not really been able to absorb that move in yields as it's coming at a time when it's not as if the economy's, off to the races. I think we had a collision of really excited economic expectations for next year, kind of encountering not so great or just okay current data, and then the question of whether the Fed is going to start to restrain its cutting path again. I don't think any of it is really kind of fatal to the bull case, but it is a rethink.
Yeah. All right, good stuff, Mike. Thank you. We'll see you coming up soon. Seema, tell us about the chips.
Yeah, a strong day for semis, Scott. Just take a look at Broadcom, up another 6% today. It started the month at $160 and change, and now trading at around $232. With that said, it's still underperforming software stocks in the second half of the year. Bank of America analyst Vivek Arya says this rotation into AI software names, that could challenge chip stocks in early 2025. He also lists it as one of the wild cards going into next year, in addition to tariffs and new restrictions put on China. But Scott, let's compare price to earnings ratios for software versus chips. Salesforce, for example, a valuation of 31 times forward earnings, getting closer to NVIDIA and Broadcom. And then we're watching, of course, the government. Any appointments there? President-elect Trump appointing Sriram Krishnan, a former Andreessen Horowitz partner, to a senior AI policy advisory role. He's seen as supportive of AI and onshoring of chip production. So we'll see how that plays out for companies like Intel, which is expected to make progress on its Arizona plant, and of course Taiwan Semi, which is expected to ramp volumes of its AI chips in mid-2025, Scott.
Seema, you've been watching too, over the last week, these incredible moves in Broadcom. As that stock really picks up, right? It was up like 40% in some 3 days. And here, as I look at it again, I know you were talking about it, it's up another almost 5.5%, 6%. So it's not just NVIDIA's game here. This stock is considered the second best by some analysts way to play this big AI boom.
Yeah, and there's companies like AMD that have tried to compete with NVIDIA, but they've found it to be incredibly tough. But then you have Broadcom, which is saying, all right, we can't do it alone, so we're going to partner with the big hyperscalers like an Apple and OpenAI and Microsoft and Amazon. We'll help them develop their in-house chips. And that strategy seems to be paying off. That epic guide from CEO Hock Tan of Broadcom, that's really playing into their guidance and why I think seems like more investors are getting more bullish on this name going forward, Scott.
All right, Seema, thank you. That's Seema Modi. Let's pivot to Apple. Steve Kovac, which is hitting yet another new high, getting ever closer to $4 trillion in market cap. Was like 3.8 something earlier today.
Yeah, maybe not going to hit it by the end of the year, but I feel like I come on just about every day now this month, Scott, saying that there's a new intraday high for Apple, even though there's not a ton of news driving Apple stock. Today, for example, though, we did get some bullish commentary from who else? Wedbush's Dan Ives on iPhone sales getting a lift from artificial intelligence, but we really won't know how well that thesis is playing out until early next year when we get Apple's report for the December quarter earnings wrapping up here in a few weeks. And then we had this report from Bloomberg that came out yesterday morning, a facial recognition doorbell in the works over at Apple. By the way, that's not the only smart home gizmo that's going on over there. Ming-Chi Kuo from TF International Securities said in the fall, Apple's also working on a connected security camera for the home. Unclear how serious Apple is about those jobs or those products, but more important there is Apple has expected a new push into the smart home as soon as this spring. Apple has been playing in that space for almost 6 years now. Bloomberg reporting Apple is expected to launch a new tablet for controlling smart home appliances that could come probably in the March or so. This is a new kind of iPad that you stick to your wall and has limited functionality for controlling smart home appliances in your home. But look, still need the iPhone business cranking again over at Apple. Also expecting a new iPhone SE, the cheaper model of the iPhone, in early 2025 as well. Couldn't come soon enough for Apple, Scott.
Well, you just underscore the biggest issue we're going to be watching for next year. That's upgrade cycle, right?
Exactly.
First and foremost.
Yeah, that's exactly it. And whether or not this thesis plays out, that Apple Intelligence, which now is pretty much launched, at least most of the features that have been talked about, especially the ChatGPT integration that came out just a couple of weeks ago, whether or not that really is driving iPhone upgrades. We know, I will note, most analysts for the December quarter, it's pretty lackluster, these estimates that they're showing, and not really returning to the growth that Apple is known for with the iPhone business. Services is doing super well, though, growing at double-digit percentage points for the last several quarters there, Scott.
Yeah. All right, Steve. Thank you. It's Steve Kovach. Interesting moves in the markets today. Bond yields higher. 10-year near 460. It's at 458 now, but that's not stopping this late day pickup as we look at some of the bigger movers beyond the Apples of the world. It is NVIDIA having a good day. Many of the mega cap stocks as well, and even a pickup in names like Morgan Stanley, JP Morgan, Citi, and Goldman Sachs. I'll send it into OT with Mike and Leslie.
Thank you, Scott. That's the end of regulation. 3rd Street Music School ringing the closing bell at the New York Stock Exchange. The Bowery Mission doing the honors at the NASDAQ. Stocks closing near session highs with solid gains for the NASDAQ and a decent bump for the S&P 500 as chip stocks get the boost. That's the scorecard on Wall Street, but the action's just getting started. Welcome to Closing Bell Overtime. I'm Leslie Picker with Mike Santoli. John and Morgan are off today.
All right, coming up this hour, former Ford CEO Mark Fields joins us to talk about the official merger negotiations that were just announced between Nissan and Honda and what he expects from auto stocks broadly in the new year.
Plus, banks are about to wrap up a solid year of returns, but can they repeat their outperformance in 2025? We'll talk about the names that should be at the top of your watch list for the new year. Let's break down today's market action with Ariel Investments Vice Chairman Charlie Borbrinskoy and Hennian and Walsh Asset Management President and CIO Kevin Mon. Thank you both for being here. Kevin, let's start with you. So chips leading the way, very decent performance for the NASDAQ. Lighter week, of course, with the holiday and so forth. But what's your read on today's action?
I think today's rally in chips should remind all investors that the AI revolution is a long road. And there's going to be many ups and downs and many potholes along the way. And semiconductors and chips will likely remain a critical component of the overall AI ecosystem, but not the only component. But let's not forget about energy, data centers, hardware, and software. And then, of course, NVIDIA is not the only semiconductor and chip opportunity that's out there. Look at Broadcom, look at Advanced Micro, look at even Intel. All priced pretty rich right now, but all have more growth ahead. And if I can remind everybody watching right now, NVIDIA is going to become the hub of the AI ecosystem. They have very aggressive delivery schedules ahead with the Ultra version next year at Blackwell, and of course Rubin and the Ultra version of Rubin coming in 2027 after that, plus their continued growth in data centers. I wouldn't bet against NVIDIA.
Well, and of course they're comprising such a big part of the overall market as well. Charlie, I want to turn to you. Given kind of what we've seen with NVIDIA, what we've seen with chips this year, which there's no way to really describe the market action in 2024 without them, would you be rebalancing your portfolio now in anticipation of 2025? And if so, how?
Yeah, if I owned a lot of chip stocks in NVIDIA, I would absolutely be rebouncing. I mean, at this point, it is very dangerous to own stocks where they are so popular. I teach classes at a couple of eighth grades, and the one thing that these eighth graders all want to do is own chip stocks in NVIDIA. They tend to want to own what's worked in the past and don't care a lot about valuation. I'm not saying at this point I would sell it all, but clearly there's a very high expectations in these names. We're contrarian investors. We try to buy what hasn't gone up, and clearly semiconductors are not that.
Yeah, Charlie, I mean, I know that's typically your stock and trade. It's your temperament and orientation is to look at what is not appreciated by the market yet. It's paid off over time, but it's been tough this year. It's a very uneven performance, even though it's a very lucrative year for the second straight year for the indexes. Do we have the ingredients for more cyclical stocks, value stocks to start to work, given this rethink of what the Fed's going to do and just maybe a little bit of a stutter step in some parts of the economy?
Yeah, as you know, Mike, it's tough for us value investors to make short-term predictions. We don't think we or anybody else is good. But the core answer to your question is the ingredients are there. We have very high quality value names trading at very reasonable prices when the rest of the market is very expensive, when interest rates should be coming down, and when there are some negatives that could start to go away. We could start to have the situation in Russia, Ukraine get a little better. We could start to have the situation in the Mideast, which has been so fraught, get a little better. But we have great companies like the Goldman Sachses of the world and a lot of energy names and building materials names trading for very reasonable multiples. So the ingredients are there, but it's been tricky versus growth.
Kevin, in the immediate aftermath of the U.S. election, yes. You had this kind of tension release, this little bit of a burst of enthusiasm, and it's almost as if we got a little bit tricked by the fact that there was an apparent perfect playbook for this, which was 2016 into 17. Yes. That worked for about a week. Yes. And then it was unwound. Now, the market itself has hung in there. It's not as if it's all fallen apart, but it has been a growth-centric market again. What are your expectations right now in terms of what the policy influences are going to be? Because for a while, you could just decide which ones were going to be implemented and invest based on that.
Yeah, I think, Mike, the next year is going to look very different than the last year. The next 4 years are going to look very different than the last 4 years. And the next decade is going to look very different than the next decade. But certain themes still resonate. First and foremost, the AI revolution. And I would implore investors, again, to look beyond just the chips companies and consider the data centers and the cooling solutions and the power solutions that are associated with the AI revolution. How about our country's need to replenish, upgrade, and modernize our defense and security capabilities? There's going to be more money spent in defense spending, and the largest defense contractors are likely to benefit, such as Lockheed Martin. And then I go back to banks. I think the rebound that we've seen in regional banks is only going to continue in 2025 because with yields coming down, Treasury prices are going up. The threat of less regulations, lower capital requirements, we could see more consolidation in that space as well. So investors should expect a continuation of the bull market, but not at the pace that we've seen over the last 2 years. You're going to have to be a lot more selective going forward.
The consolidation question is a big one. Charlie, lastly, I want to get your thoughts on the Fed, because you've been a bit critical, at least in the producer notes, about their performance so far. I'm just curious, kind of, what do you see as their biggest shortcoming, and do you think it's their fault, or do you think it's due to exogenous factors?
Yeah, so I spend a lot of time in the auto insurance industry, and the greatest predictor of accidents is not actually speeding, it's hard braking and hard accelerating and swerving. And that's because people that are behind a car that behaves like that find it very difficult to follow, and there tend to be a lot more accidents. And that's what this Federal Reserve is putting on the gas, putting on brakes, veering left, veering right. They took interest rates to zero when they mistakenly thought inflation was going to be transitory. Then they took up interest rates faster than anybody has before. Then they made what I said at the time was a mistake by cutting rates by half a point, by 50 basis points, and now they're reversing again and saying they're only going to be 2 cuts next year. So they've been all over the road, and it's making the market more volatile than it needs to be, and it's making investors less sure than they should be, and that's a big problem going forward.
Well, although, Charlie, they did nothing for 14 months in terms of rates, and they talked a bit about it. And we have, 4.2% unemployment and 2.5% inflation. Are we paying the price for what you consider to be an erratic Fed?
Yeah, well, I'm a Milton Friedmanite here in Chicago at the University of Chicago. And what we believe is that you want steady, predictable policy from the Fed with steady growth in the money supply. And we've had anything but that. And Mike, it's just giving us more uncertainty than is good. And so we still have, frankly, cyclical stocks that are not sure what the Fed is going to do and therefore aren't getting the kind of valuation they need. If we could get a dependable, predictable Fed, we could have the kind of performance in buildings, in home supply, in autos that a lot of us are looking for.
Yeah. All right. Well, I'm sure we'd all love more predictability. See if we can somehow get it in the new year. Charlie, Kevin, appreciate it. Thank you very much. Pleasure. All right, a number of deal headlines crossing the tape today. Nordstrom said it's going private in a transaction worth more than $6 billion, or about $24.25 per share, led by the founding family as well as a Mexican department store. Meantime, Xerox posting its best day of the year after announcing it's buying printer maker Lexmark. Those shares ending the day up by 12%, it looks like. But the biggest deal news today comes from Japan, where Nissan and Honda say they have officially entered merger talks. The combination would create the world's third largest automaker by sales. Joining us now is Mark Fields. He is the former CEO of Ford, as well as a CNBC contributor. Mark, it's great to have you on this pretty big deal, I would assume, in the industry. And it's interesting, you know, I don't want to take too much of a message from one day, but the shares of Toyota and GM and Ford were actually up on this news. Pretty acknowledged that global auto capacity perhaps is too high. Do you think that's the case? Do you think this potential deal would do anything to help that out?
Well, you know, I do think this deal is really about, Nissan has been in a long-term sales decline. They have a lot of debt. They have dwindling profits and cash. And at the same time, they recently had an activist get into their stock. And also at the same time, Foxconn, the Taiwanese manufacturer, made an advance to them. And so I think this really pushes Nissan to approach Honda, and it probably was helped by the Japanese government, the Ministry of International Trade and Industry, because they want to make sure they protect these, Japanese blue chip companies. But I think what you'll see is, listen, they have too much capacity right now. Nissan, I think this year is running at about 65% capacity utilization, which anytime you run below 80%, you lose a lot of money. So in this case, I think for Honda, the benefits is it gives them scale, gives them access to potentially, some truck technology that Nissan has. And in Nissan case, it gives them, a partner, and it allows them to restructure. So I think you'll see capacity come out of the industry. But make no bones about this, Mike. This is about the Japanese government really wanting, two major auto groups, Toyota and their group of companies, including Mazda and Subaru, and Nissan and Honda, to protect them from the onslaught of more competitors and a lot of new technologies. Yeah, and you mentioned just the need for scale, and it's such an interesting position that so many of these companies find themselves in, which is just massive necessary capital spending and research expenditures for whatever the energy transition is going to be to ramp up electric and hybrid capacity. At the same time, the payback is getting a bit unclear, and China just keeps building capacity in that area. So on what basis are all these companies making these new investments in terms of what they think they're going to get out of it? Well, I think what you're seeing, you've seen this in the auto industry literally over the past 12 to 15 months, right? Prior to that, there were a lot of investments in EV capacity and components, and they thought the market was going to adopt to EVs very quickly. That has not happened. So you've seen a lot of automakers all around the world basically write off capital expenditures. So there was a lot of stranded assets that they've had to write off. And so I think you're seeing going forward this pressure, even before the amount of investments, the profit on EVs is very elusive. The only ones in the industry making profits on EVs is Tesla. You layer on top of that a slower industry, and that's forcing companies to make really tough decisions about rolling back these investments, writing off investments as well, and driving them into partnerships, because they're going to need these partnerships to spread these investment costs, because they just don't know how fast the market is going to uptake on EVs, and therefore they want to create a hedge.
So in addition to this one, Mark, do you see this spurring other partnerships, joint ventures, and even some mergers in the new year?
Well, Leslie, it's a great question. First off, I see more partnerships. I do not see a rush to consolidation in the industry because let's face it, this Honda-Nissan merger agreement is really a bit of a shotgun marriage because of the issues at Nissan and their dwindling profits and the fact that they've misread the market, particularly here in the U.S. And so I think a lot of this was being thrown into their arms, not only because they're looking at their own numbers and a lot of debt due in the next 2 years, but also the Japanese government saying, we think you ought to do this. But in the rest of the industry, I continue to see more partnerships. You're seeing it with folks like GM and Hyundai. You're seeing it with others, and I expect that to continue. But I do not expect to see a rush to mass consolidation. If for any other reason, these are national champions in these countries, and the governments really want to keep these companies headquartered in their own locations. So for in-country mergers like you're seeing with Honda and Nissan makes a lot of sense.
Yeah, it's a fascinating story, just emblematic of the market as well as the competitive posture across the world in automakers. Thank you, Mark Fields. Appreciate it.
You bet.
When we come back, your bank stocks playbook, financials broadly outperforming the market in 2025 with major players like Goldman Sachs, Wells Fargo, and JP Morgan each up 40% or more. We will discuss if that rally will continue and the names that should be on your radar in the new year.
And later, PIMCO's head of emerging markets breaks down the outlook for stocks outside of the U.S. and how a second Trump administration will impact global investors. Overtime is back in 2 minutes.